everyone. So for the next 10 minutes or so, I will be giving you a focused update on key UK corporation tax developments as we look ahead throughout FY 2026 and ahead. So key things for finance teams to be aware of. I won't try to cover everything. Really, it's going to be a focused update on and trying to highlight key areas. So the areas where we're seeing the biggest practical risks, biggest practical impacts, the highest level of HMRC scrutiny as well, increased areas of risk for HMRC, and just also the areas of greatest planning risk for finance teams to think about. So I'll be covering 4 main areas today. So I don't know if everyone can see those on the slides. But I'll be covering, as I say, 4 main areas. So a high-level update following the Finance Act of 2026 and a summary of the government's longer-term direction of travel on corporation tax. Secondly, an update on capital allowances, including the key changes to writing down allowances, the new 40% first-year allowance, and how these interact with existing relief such as full expensing. Thirdly, we're going to take a look at share-for-share exchange rules. These are particularly relevant in group reorganisations and corporate transactions. And finally, we'll have an update on the associated companies rules. And this is a particular area of focus for HMRC. So, and this has a real impact, direct impact on tax rates, thresholds, and overall compliance risk. So, starting with the broader corporation tax landscape. So, alongside the budget from 2024, the government actually published its corporation tax roadmap, which takes us through to 2029. So the key message here was all around stability rather than reform, and the introduction of the roadmap. So alongside the introduction of the roadmap, there have been no changes to headline corporation tax rates. And the intention there is to provide businesses with a predictable framework and help support them in their investment decisions. Crucially as well, various key UK tax incentives will remain in place throughout the roadmap period. So full expensing, this will continue to be a central feature of the system. This broadly provides 100% upfront relief for most capital expenditure. R&D will continue to be available, although there are increasing compliance and evidential requirements to substantiate claims. And SSE, so the substantial shareholding exemption, this will remain unchanged. This provides an exemption for corporation tax to businesses who are disposing of their trading subsidiaries. Another notable update from the Finance Act 2026 is the doubling of late filing penalties. So whilst this isn't a technical change, I think it's very relevant from a governance perspective. What we're seeing here is HMRC trying to use penalties very much as a behavioural lever. So timely filings and accurate returns are going to become more important. And finally, just a quick update on a number of key consultations which have concluded recently. So there have been consultations around advanced certainty on major investments, several transfer pricing consultations, and also one on advanced certainty for R&D. So I won't touch on transfer pricing and R&D here because we've got a couple of presentations on those coming up later. But with regards to the advanced certainty on major investments, so this is a new scheme expected to go live now from July 2026. It's going to apply to major investment projects though, so really large scale projects with a minimum of 1 billion of expenditure, UK expenditure. The benefit though of the scheme will ultimately be upfront tax certainty on multiple taxes, which will be binding on these large scale projects. And this really is, I think, another step in a common theme that we've been seeing from HMRC for a number of years now, which is a push towards engaging with businesses earlier, getting upfront clarity, rather than constantly resolving disputes after the event. So turning now to capital allowances and starting with changes to the writing down allowances. So from April 2026 this year, so the main rate of writing down allowance will reduce from 18% to 14%. The special rate writing down allowance, though, will remain unchanged at 6%. Now, this change, this reduction from 18 to 14%, this predominantly impacts relief for historical qualifying spend where the relief has not yet been fully claimed. And that's because most new expenditure is going to qualify either for full expensing or one of the other enhanced reliefs that are available. Now, partially offsetting this introduction, the reduction from 18% to 14% is an introduction of a new 40% first year allowance, which is for main pool expenditure. And this is on expenditure incurred on or after 1st of January 2026. So a few key points to stress here. This 40% allowance is for main pool assets, not special rate assets. But crucially, it is available to unincorporated businesses and also businesses who lease assets, being a key distinction there from the full expensing regime. Also, a point to note is this is a separate relief from the 50% first year allowance for special rate expenditure, which already exists. And one final point to note is around the 100% first year allowances for qualifying expenditure on zero emission vehicles and electric vehicle charge points. So this has been extended by a further year and will now run until March 2027. So staying on the topic of capital allowances, but moving on to AIA. So no changes announced here, but I think it's worth highlighting how this is such an important relief and an extremely valuable relief as well. So the AIA annual limit remains at £1 million per annum, and this provides 100% relief on qualifying capital expenditure each year. It continues to be available for both new and used assets. And what we see in practice for most SME businesses, certainly, is that this covers the vast majority of their spend, if not all of it, qualifying expenditure throughout most years. For larger groups, I think the key point to watch out for here is that the AIA, the 1 million, that's spread across the group. So if you have particularly lumpy capital expenditure or it's concentrated in certain group entities, just one to watch out for there that you need to spread that. And then finally on capital allowances, just moving on to full expensing. This very much remains the flagship policy, and this provides unlimited 100% relief for qualifying main rate plant and machinery, but it is only available to companies and the assets must be new and unused. For special rate expenditure on things such as integral features, long life assets and solar panels, a 50% first year allowance continues to apply. So a few practical points here to stress. So cars are excluded, although some vehicles might qualify. There is also there's clearly a significant cash flow advantage here of being able to expense things fully in the year of expenditure compared to using writing down allowances. However, there is a clawback. So on disposals, there will be a balancing charge when assets are sold. From a finance perspective, as I say, this remains an incredibly beneficial relief compared to previous regimes, particularly compared to writing down allowances. And the cash flow benefit is certainly worth considering when you're planning any capital expenditure. So just moving on now to share-for-share exchanges. For those of you that have been through any group restructuring or corporate transaction exercises, you may well be familiar with these rules, as they're a commonly used structuring mechanism. Very broadly though, where the necessary conditions are met, the relief basically applies and gives an immediate relief to any immediate tax charge, ultimately deferring any gain into the newly issued shares. However, the rules have been significantly amended, giving HMRC much broader powers to counteract the reliefs available here. So the key changes being the removal of the commercial purpose test, the removal of the exemption from the anti-avoidance for shareholders of less than 5% has also been removed. And ultimately, this has been replaced by a new just and reasonable disallowance to the relief. And this applies where there is a main purpose or one of the main purposes of any arrangements associated with the share exchange, where that main purpose is to reduce or avoid capital gains tax or corporation tax. So what does that mean in practice? Well, really, it's lowered the bar for HMRC to challenge these types of arrangements and deny relief. And they can now look at the wider set of arrangements that the share exchanges are part of. And if there's a main or one of the main purposes is tax avoidance in any of those steps, they can deny relief. So the new rules apply from 26th of November 2025, but if clearance was submitted before that date, it was still possible to apply the old rules, but the transaction did need to be completed before the 26th of January 2026. So for finance teams, key message here really is that group reorganisations and share exchanges just carry a high level of risk. I think early advice and possibly advanced clearance from HMRC are going to be more important. Quickly turning to our final topic then, associated companies. As I said earlier, this is very much an area of increased HMRC scrutiny. A lot of groups might already have seen a one-to-many letter being received from HMRC asking for confirmation of their associated company's position. The definition of an associated company was widened significantly from 1st of April 2023. And in short, this now means that companies are associated with one another if one controls the other, or crucially, if they're both controlled by common persons. And that can include individuals, partnerships, and trusts. The definition includes all worldwide companies, but does exclude dormant companies. So what we're seeing in practice is HMRC challenging assumptions that may have gone unreviewed for a number of years. And I think this is particularly relevant in owner-managed businesses or private equity-backed structures. So the reason this matters so much, the impact that it has ultimately on corporation tax thresholds. So we've got an example here. So as the number of associated companies increases, the main rate limit, the quarterly instalment payment threshold, and also the very large threshold, these are all divided by the number of associated companies. So using the example here on screen, the thresholds would normally be 125,000, 750,000, and 10 million for a group of 2 companies there on the left. But we can see that those figures drop significantly. In fact, they're halved with the introduction of 2 new associated companies, where those are introduced by virtue of their common ownership for an individual. So this can push companies into higher effective tax rates. It can certainly bring forward instalment payment deadlines for corporation tax, and ultimately just increases overall compliance complexity. So for finance teams, this is just an area where, unfortunately, simple factual errors can actually have really big impacts on both cash flow, can result in penalties, and also just reputational risk with HMRC. That brings me to the close of the corporation tax section. So thank you for your time. And I believe I'm handing over to Scott, who is going to take you through the R&D update.
Thanks, David. Yeah, that point is not to be underestimated. Really important to understand the number of associated companies. If you're in that below that kind of main rate limit, you pay your tax like 9 months after the year end. If you're in that very large threshold, you could be paying it, sort of 2.5 months into that period.